Hi everyone, I am Nicolai Canceran, partner from Tax Advisory and Compliance Division. Welcome to Tax News. I am happy to share with you relevant matters on Philippine taxation. Our first topic this year will be on transfer pricing. Most of you are probably excited to know about it. Yes, it is quite a difficult subject, but no worries. I will do my best to simplify it for you for your better understanding. It is said that transfer pricing is the most significant international tax issue confronting tax administrations worldwide, emerging from increased globalization of trade. Typically, a transfer price occurs between a taxpayer of a country with higher income taxes and a related party of a country with lower income taxes. While transfer pricing issues typically occur in cross-border transactions, it can also occur in domestic transactions. One context where a transfer pricing issue occurs domestically is where one related party entitled to income tax exemptions is being used to allocate income away from a company subject to regular income taxes. Again, transfer price occur between or among related parties. And who are related parties? Two or more enterprises are related if one participates directly or indirectly in the management, control, or capital of the other. For example, between the parent and its wholly owned subsidiary, or between the ultimate parent and subsidiary, between companies with common ownership or common control. Some of the reasons that drive group of companies in setting up transfer prices for related party transactions include minimization of tax, repatriation of capital, exchange rate difference risk, and window dressing of financial statements. Because of these tax-driven transfer pricing motives, the arm's length principle is introduced. The arm's length principle is the internationally recognized standard for transfer pricing, which provides that a transaction with a related party should be made under comparable conditions and circumstances as transactions with an independent party. There are 5 transfer pricing methods to apply the arm's length principle. Comparable uncontrolled price, resale price method, cost plus method, profit split method, and transactional net margin method. The method that provides the most reliable measure of an arm's length result shall be used. Where do we get independent comparables to apply different methods? The following are the sources of independent comparables: market price of commodity products, Bangko Sentral ng Pilipinas offered rate, Philippine Securities and Exchange Commission database, commercial database, internal comparables, which means that a related party has transaction with another related party and at the same time has comparable transactions with an independent party. To support that the transactions with related parties conform with the arm's length principle, a transfer pricing documentation or TPD must be prepared. A TPD shall include organizational or group structure, nature of the business, industry and market conditions where the parties operate, nature of the related party transactions, comparability, functional and risk analysis, selection of the transfer pricing method, application of the transfer pricing method. The TPD is ideally prepared prior to the transaction or at the time of the transaction or after the transaction but not later than the due date of the filing of the annual income tax return which the transaction takes place. Who are required to maintain the TPD? There are 2 level criteria. Level 1. those who are large taxpayers, taxpayers enjoying tax incentives, taxpayers reporting net operating losses for the current taxable year and immediately preceding 2 consecutive taxable years, a related party which has transactions with taxpayers enumerated above. Level 2, who will meet the following materiality threshold: annual gross sales or revenues for subject taxable period exceeds 150 million pesos, and the total amount of related party transactions with foreign and domestic related parties exceeds 90 million pesos. The related party transactions involves sale of tangible goods. The aggregate amount exceeds 60 million pesos within the taxable year, or involves service transaction, interest payment, use of intangible goods, or other related party transactions in the aggregate amount exceeds 15 million pesos within the taxable year. If the TPD was required to be prepared during immediately preceding taxable period for exceeding either 1 and 2 above. The TPD and other supporting documents shall be submitted within 30 calendar days upon request of BIR during tax audit. I hope I was able to effectively discuss this timely and relevant topic with you. Don't forget to like, subscribe, and hit that ring bell button to be notified on our next topic. If you have another new topic you want to learn about, just drop by our official PNA Grand Thornton social media accounts and we will gladly share with you our insights.